Visa stock is up over 13% year to date, outperforming the stock market by almost triple. However, over the past 5 years, Visa has been underperforming the market by a slight margin. While most people believe Visa is a bank type of company, Visa is actually the complete opposite and is basically a technology company. Visa is basically the middleman between the bank and the consumer. Visa basically just offers security of funds from the consumer to the bank, which allows Visa to have a very high profit margin and is one of the biggest moat companies in the entire world, meaning they have a great competitive advantage. So today in this video, I'm going to be analyzing Visa stock using my 7-step stock analysis, and at the end of the video, I'm going to decide whether or not we should buy Visa at the price today, and what we believe the intrinsic value of Visa stock is. The first metric of my 7-step stock analysis is the PE ratio. I want the PE ratio to be greater than 0. If the PE ratio of Visa is greater than 0, that means the company makes money. So we want Visa to be profitable. As we can see here, they have a trailing PE ratio of 35.96, which means Visa is a profitable company. However, it might be a little overvalued because we want the PE ratio to be around 20. Since the total stock market is about a 20 PE ratio, if it is higher, that means it looks a little bit overvalued. However, we do not know for sure. The next metric that I like to look at is the forward PE ratio, and I want the forward PE ratio to be less than 30. The reason I want it to be less than 30 is because if it is less than 30, it is pretty likely that it's undervalued considering their future estimates from analysts. So as we can see here, forward PE ratio for Visa right now is a 31.65. So that is an X, but it is pretty close to our metric, so it's not a terrible X, but it is an X overall. The next thing I'm going to look at is the revenue growth of Visa. This is basically the total amount of sales that Visa has had, and we want this to be increasing at a greater than 5% rate. Great increasing revenue, and it's just very constant, which is very good for us and shows that it's pretty reliable revenue growth. And it's been growing at about an 11% rate over the past 10 years, so that is another check mark for Visa, and so far it looks pretty good for Visa. Next, I'm going to look at the earnings per share of Visa, which is basically the net income of the company divided by the shares outstanding. So this factors in buybacks and the total net income of Visa. And as we can see here, we want this to be greater than 5%. And it looks very good, increasing at a very consistent rate, very similar to the revenue. So it's been increasing at about a 15% rate, so this is also another check mark for Visa. On the financial side of Visa, it looks very good. Next, we're going to look at the shares outstanding of Visa. We want Visa to be buying back shares. If the shares outstanding decrease over time, that means Visa is not diluting us shareholders and actually reducing the amount of shares that people can buy, which means your shares are going to be more valuable since there's less supply of the shares. And as we can see here, they have been buying back shares basically every quarter, which is very good for us. They are not diluting us at all. And as we can see here, they have bought back a ton of shares just in the past quarter. Over 7% of shares. That's very good. So that's also another check mark. Now I'm going to look at the total debt divided by equity for Visa. We want this to be less than 100%. If it's less than 100%, that means Visa has more equity than debt. So it's probably unlikely for them to go bankrupt since they don't have as much debt as equity. And as we can see here, they have about 53.82% total debt to equity ratio, which means they have about double the amount of equity. So that is a check mark for Visa on the total debt to equity ratio. The final metric that I'm going to look at is the EPS growth expected by analysts. We want this to be greater than 5%, and the reason a stock goes up is mainly because the earnings per share of a company, especially if you buy it at the right price. As long as they're going to grow the company, that means the stock price will go up. So we want the future earnings per share from analysts expecting to go up. So as we can see here, they're expected to grow at about a 13.3% rate over the next 5 years. So this is very good for Visa, greater than our 5%, so that's also another check mark. And that's 6 out of 7 check marks, so that's good for Visa. The final thing that I'm going to do for Visa stock is use an intrinsic value calculator to determine what price we should pay for Visa stock. So with this intrinsic value calculator, I have to input assumptions for the next 10 years to determine what we should pay for the Visa stock. So the first thing that I have to do is do a revenue growth rate for the next 10 years, what I think it will be. As we saw, they were expected to grow at about a 13% rate. So I'm going to put 13% for Visa. Then for the net profit margin, we can see it's been around 50 to 55%. So I'm going to put this at about a 55% net profit margin. I think they can increase this slightly higher. So we're going to put that at 55. Now for the PE ratio. Over the past 10 years, we have seen it is at about a 30. The total stock market is around 20 PE ratio. But I think Visa is a slightly more valuable company, so I think it can have a higher PE ratio. So I'm going to put a 25 PE ratio for Visa. Discount rate I'm going to leave at 12%. Since the stock market on average returns about 9%, I want a slight margin of safety, so I'm going to put that at 12%. And as we can see here with Visa, I think the fair value price for Visa right now is $377.17. So if you bought it today, you'd probably get about a 12.8% return if my assumptions are true. So thank you guys for watching this video. Please leave a like. Please comment down below what stocks you want me to look at next. See ya.